Welcome back to Getting Your Shit Together, the podcast where we dive into all things mortgages, real estate, and financial strategies to help you get the most out of your money. I am Neil, and always am joined by my co host Jerome. Today, we are going to unpack a strategy that can turn the mortgage on your primary home, which is likely your biggest debt, into an investment opportunity. We are going to talk about the Smith maneuver.
Hey, Neil, the Smith maneuver is definitely one of those strategies that a lot of people hear about but don't fully understand. So, there's a lot of misinformation about this strategy, and for starters, like what exactly is the Smith maneuver? Can you break it down a little bit more for us?
Absolutely. The Smith maneuver is a Canadian tax strategy that converts non deductible mortgage debt into taxable investment debt. And so let's start by defining what those terms mean. So basically, in Canada, you cannot deduct the interest you pay on your mortgage from your taxes, which is different from the US system. And that's a big disadvantage for Canadian homeowners. That is what we call as non-deductible mortgage debt. On the flip side, if you borrow money to invest in something with an income generation potential, like stocks, bonds, real estate property, or even your business, the interest on such a loan is tax deductible. And the Smith maneuver takes advantage of this feature. The idea is to borrow against your home's equity, invest those funds, and make the interest on that loan tax deductible. You can then use the tax refund or the income generated to pay down your mortgage faster and keep repeating the process every year.
Well, that sounds really intriguing, Neil, but it also sounds kind of complex. So you're borrowing against your home's equity. Does that mean you need a specific type of mortgage to pull this off?
Yes, one would need something called as a readvanceable mortgage. It is a combination of a traditional mortgage with a home equity line of credit, or HELOC as it's popularly known. The feature of this mortgage is that as you pay down the principal on the mortgage, the credit limit on the home equity line of credit increases. Essentially, you can access that equity and then use it for investments.
Got it. So the idea is to constantly invest those borrowed funds while making your regular mortgage payments. But what's the real benefit of doing this? I mean, what is a Smith maneuver? What makes it a smart move for most people?
Mhm. Great question. So, there are a few key benefits. Firstly, the tax deductibility of the interest on the HELOC effectively lowers your borrowing cost. So, for example, let's say you are in a 40% tax bracket and the interest rate on the home equity line of credit is say 6.95%. But given the tax advantage, your effective rate becomes closer to 4.17%. So, if your investments are earning more than that rate of return, you are in a good position. Secondly, you are simultaneously paying down your mortgage and building an investment portfolio. Over time, if your investments perform well, you could significantly grow your wealth while also reducing your mortgage faster than you would with the traditional approach. This strategy helps homeowners diversify their assets and not only rely solely on the home for wealth building, which is important.
So the Smith maneuver kind of sounds like a win-win. But I can see how some people might be concerned about borrowing to invest. So tell me, Neil, what are some of the risks involved with the Smith maneuver?
Absolutely. And there are risks involved. While the benefits can be great, it is not without risk. The most obvious risk is market volatility. If one is borrowing against their home's equity to invest, but those investments lose value or go bad, they are still responsible for paying back that loan. The bank is not going to forget. So one would need to be extremely savvy and be comfortable with some level of risk taking and have a long term investment mindset. I would suggest working with an investment advisor or an expert in whatever assets you're investing in, just so that you are sure. Another risk, of course, is the risk of rising interest rates. If the interest rate on your home equity line of credit, which obviously grows every month, and if that rate is increasing, your overall borrowing cost could be higher. And so, if your investments aren't performing as well, to offset those costs or not keeping up with the value, then it could create a financial strain. So, this strategy isn't for everyone. It is ideally for someone who has a strong risk tolerance or a high risk tolerance and an ability to weather some potential downturns. Additionally, some lenders might ding your ability to get another mortgage or a loan if you have a significantly large limit on the line of credit, or even if you're utilizing most of it. Plus, it can get harder to get a loan or a mortgage if you have borrowed a large sum of money on the line of credit. While there are some ways to get around it, it would require you to work with a mortgage broker who knows how.
Well, that certainly makes sense. And it's definitely not a set it and forget it kind of strategy. You're not just going to leave this one alone. I imagine working with the right professionals is really, really essential for this product. So, Neil, tell me, who should be a part of the team when you're implementing a maneuver like the Smith maneuver?
Since this strategy touches on several key areas, for example, taxation, financial planning, investment, and mortgage management, not one individual might be able to cover all of these areas. And so you would need a knowledgeable team who can cover all these aspects for you by means of maybe having a tax accountant, a financial planner or an advisor, and a mortgage broker who are familiar with how to structure this strategy properly. Each professional plays a role in ensuring that it is set up correctly and you avoid pitfalls which could be costly if you try to wing it. Plus, the strategy itself might require you to spend some time, maybe about 30 minutes a month, just to manage the setup on an ongoing basis.
Right. I mean, 30 minutes a month doesn't sound so bad for the potential returns, but I also imagine that there are regulations and tax implications that need to be navigated carefully.
Oh, yes. One would need to be sure that the borrowed funds are strictly used for income generation purposes. It cannot be used to buy a car for your personal use. The interest, and if you do so, the interest may not be tax deductible. It is not as simple as taking out a line of credit and doing whatever you want with the funds. Proper accounting, documentation, and planning is key to success.
Okay, so for someone who's interested in this Smith maneuver, what are the next steps for them? How do they know if it's the right strategy for them?
Firstly, they should evaluate their financial goals and their risk tolerance. Are they comfortable with leveraging their home equity to invest? Do they understand the potential risks of market downturns or rising interest rates? Next, obviously, they should speak with a mortgage broker like us to explore if a re-advanceable mortgage is an option for them. Lastly, they also need to ensure that they have a long-term investment plan that aligns with their financial goals and risk profile.
This is great advice, Neil. It really sounds like the Smith maneuver can be a game changer for the right person, but it's definitely something that requires a lot of careful thought and planning.
Absolutely. It's an excellent wealth building tool, but you have to go in with your eyes wide open. This strategy isn't a quick win, it's a long term play that can provide huge benefits if done correctly.
Awesome. Before we go, Neil, can you share any personal experience you have implementing this strategy?
For sure, let me provide some insight into what I have accomplished and what I plan to do further. I learned about Smith maneuver after I had already purchased my house. So I missed the opportunity to start from day one. But I didn't let that stop me. I refinanced the mortgage at the right time when the penalty was lower and switched to a re-advanceable mortgage. I have since invested in dividend paying stocks, getting a secondary suite for rental income, and a few additional properties. Over the last 4 to 5 years, I've reduced my mortgage amortization from 30 years to 17 years. And my goal is to pay off the mortgage within the next 3 to 4 years. After that, I might plan to reinvest and maybe upgrade my home. There are definitely risks involved in doing all of this, but so far I've managed them and kept them within my risk tolerance.
Wow, that's a pretty cool story. Thanks for breaking that down. And if anyone else who is listening wants to learn more, Neil, what should they do? What's the next step?
I would say they should reach out to us directly for a consultation. We would be happy to discuss how Smith maneuver might work for their given situation. And we can also help connect them with right professionals to get started. Again, I would reiterate, it's not for everybody, but it makes sense for quite a few homeowners that I've interacted with.
Perfect. Thanks, Neil. And thank you to everybody who's tuning in to Getting Your Shit Together. Remember, those dishes in the sink don't wash themselves. So until next time.
Hello, everyone. Welcome to the second half of Getting Your Shit Together. Today's topic may not be the happiest one, but it is still an important conversation: mortgages and divorce. Jerome, this is something that can really throw people for a loop, right?
Oh, absolutely, Neil. You know, divorce is tough enough on its own, but when you add the complexity of mortgage and financing into the mix, it can certainly add to the amount of stress that there is already there. The big question that a lot of people end up with is, what now? What happens to the mortgage? How do you split the responsibility? There are a lot of options, but it's important to know what you're facing so that way you can make informed decisions.
Yeah, it's not something that's often talked about until you're right in the middle of it. But if you're going through a separation or a divorce and own a home together, one has got to make some big decisions about their mortgage. So, what should be the main options people should consider, Jerome?
Well, for starters, there are three main routes that people eventually take. First is one might decide to keep the home. In that case, they would either assume the existing mortgage or do something called a refinance or a spousal buyout to remove the other person's name. Second is simply the house could be sold, and then the proceeds are split between both sides. Third, some couples decide to continue co-owning the property even after the divorce, usually for the sake of the kids or until the market conditions are a little bit better to sell.
Okay. So maybe we can do a deep dive and let's maybe get a bit more into the scenario where one spouse keeps the home. This is probably the most common situation we see, right?
Yeah, for sure. So the person who wants to keep the home will either need to assume the mortgage, the existing mortgage, or do what's called a spousal buyout, which is kind of like a refinance. The phrase could almost be interchanged, really. The goal here is to remove the exiting person from the mortgage and the title, which can be tricky depending on the finances of the individual that's going to stay in the home and assume that mortgage, or get the new mortgage.
Mhm.
They'll have to qualify for that mortgage on their own, which means that their income, credit, and debt levels are all factored in to whether or not they can carry the mortgage by themselves.
Yeah, and that's not always easy, especially if both incomes were needed to qualify for the original mortgage in the first place.
Yeah.
The Spicer law buyout is one option, but that can mean taking on a higher interest rate or extending the mortgage term, right?
Exactly. And don't forget, when you do this spousal buyout slash refinance, you're often pulling equity out of the home to pay the other spouse, which now adds to the new mortgage amount. So if the house is appreciated since its first purchase, you might have some room, which could be good, but you could also be looking at a much bigger loan than you had before because now you have to pay more out. But for some, it's worth it to keep the home and provide that stability, especially when there are kids involved.
And then there is the option to sell the home and split the proceeds. This can be more straightforward in most cases, but that doesn't mean it's without its challenges.
Well, that is so true. Selling the home means that you both walk away with whatever equity is left after paying off the mortgage and oftentimes the other debts that were included in the matrimonial scenario. The challenge here is just timing. Sometimes the market isn't favorable, and one spouse might not want to sell right away because they want to maximize the opportunity. But if you can agree to sell, this is often the cleanest way to split things financially and move forward. And then there is the third option where you continue to own the home after the divorce. Much less common, but it does happen.
And this is probably a temporary solution, like when both parties agree to keep the home for a few years or months for the sake of their kids, or they want to wait till the market improves before selling. But co owning post divorce can be too tricky, right? You still need to agree on mortgage payments, repairs, other expenses. So it requires solid communication cooperation. That can be a big ask after a divorce, right?
Yeah.
But it make but if it works, it could make sense for some couple. So Jerome, what would you say are the most important things to consider when dealing with a mortgage in a divorce?
The first thing I would say is that each individual must get clear on your own finances. Can you afford to keep the home on your own income? Or is it better to sell and start fresh? The second thing is timing. As we've talked about, it's best not to rush into any decisions just to get over with, but it's also understandable in some situations where that is the path to take. Third is key, which is work with a mortgage professional to figure out your options. Whether you're looking to refinance or do that spousal buyout, sell, or keep it and co-own for a little while, we can certainly help you understand what's financially possible and what makes most sense for your individual situation.
Yeah, having the right advice makes a huge difference, and always. Divorce is emotional, but when it comes to your home and the mortgage, it's helpful to be practical. What are some common mistakes you see people make in these situations?
This is a good one because one of the biggest mistakes that I've seen is one party assuming that they can handle the mortgage on their own without running the numbers first.
Mm.
Um, and it's important, like we've said, to be realistic about what your income is and your expenses, especially if you're now living on only one income instead of the previous two. So another mistake is not considering the costs of refinancing or selling, like things like legal fees, penalties for breaking the existing mortgage, realtor fees if you decide to sell. All of these costs can add up. So it's important to know what you're getting into.
Plus, we're assuming that the property values are in line, right? The property is not under the water.
Yeah. Yeah.
Well, great points. As mortgage professionals, we will provide you with a detailed list of anticipated costs ahead of time so you know what to expect. A lot of people forget that there is no one size fits solution. It really depends on your individual situation, your financial standing, and what's more important to you, whether that's keeping the home, selling, or finding a new living arrangement altogether.
Exactly, Neil. The goal is to make the best decision for your long term financial health, not just get through the divorce process, although that may be a factor for some. Um, but working with a mortgage broker can really help you navigate your way through the options and avoid making decisions that really could hurt you down the road.
I think that's a good place to leave it. If you're going through or about to go through a divorce or separation and aren't sure as to what to do with your mortgage, reach out to either of us. We are here to help you figure out the best path forward, whether that means refinancing, selling, or finding another solution altogether.
Absolutely. And divorce is never easy, but making some smart financial decisions now can save you a lot of stress and heartache later, or further heartache. Thanks for tuning in, everyone. If you have questions, don't hesitate to reach out. We're always here to help and help you get your financial shit together.
And don't forget to subscribe and share this episode. Until next time, take care of yourself and your finances.